the banking regulators right now directing banks to begin to support Bitcoin. There are really good moves from the banks. They've all announced they're going to begin to custody and hold Bitcoin. That helps. I think there's some positive guidance coming from Basel and the Basel working group that they will start to upgrade the collateral value of Bitcoin for bank balance sheets. That will be very helpful. So I think that all of those things will generally accelerate institutional adoption. Every single month that goes by, there are more large institutions that come out in favor of digital assets and Bitcoin in particular. And every single time one of them announces that catalyzes another to consider doing the same.
Hey guys, welcome to Everyday Finance. As the 2025 decline continues to develop, the assertion made by Michael Saylor that Bitcoin's traditional 4-year cycle is no longer valid has become a key focal point. As a result of the dramatic decrease that occurred before the end of the year, more than 40% from the top price of $12,000 to the low $80,000 traders have been shaken up. The market, on the other hand, is behaving in a manner that gives the impression that stronger forces are now in control. Pressure has been added as a result of heavy outflows from exchange-traded funds ETFs, altering macroeconomic conditions, and panic around the possibility of index removals. Meanwhile, long-term holders and institutional players continue to exert influence over price action below the surface. In spite of the fact that sellers are losing momentum, the general sentiment is still shaky. The point that Saylor's trying to make is that Bitcoin has officially outgrown simple cycles and now moves according to global liquidity, institutional flows, and macro behavior. This moment is more significant than many people understand.
Bullish. I think that the exciting developments in the asset class are bank acceptance and credit development in the banking network. So we've seen about half of the large banks in the United States start to extend credit against IBIT in the past 6 months. And a number of banks like Charles Schwab and Citi have announced they're going to start to custody Bitcoin and extend credit against it in the first half of 2026. So I think that the real story in 26 is banker acceptance of Bitcoin, willingness to custody it, trade it, and extend credit against it. And that should catapult the asset class to new levels. Yeah, I think that the 4-year cycles are based on the Bitcoin halving, and the Bitcoin halving was really important for the first 12 years of the asset because we were cutting, the amount of Bitcoin that was being cut from the supply was very material, relative to the demand in the market. But right now you're seeing days when Bitcoin trades 50 billion or $100 billion in a single day. The total amount of the halving and the next halving is going to be 225 Bitcoin. So 225 Bitcoin times even 100,000 a coin is $20 million a day is the impact of the halving. And so $20 million isn't a first order impact on a $50 billion a day liquidity. It's not even a second order impact. It's probably a third order issue. The primary drivers of Bitcoin right now are the structural developments in the market. For example, if the banks extend $50 billion worth of credit, right, that dwarfs 20 million a day in the halving. And then when the SEC loosened the restrictions on derivatives trading on IBIT, the open interest in IBIT went from 10 billion to 50 billion in a few weeks. So you're talking about tens of billions of dollars of demand for the asset based upon the embrace of the traditional finance establishment. And so the asset class is being driven by the structure of support in the banking industry and in finance, and a few regulatory changes that are actually enhancing that support for the asset. Yeah, well, you're right. We were the first, and then there were a handful, and then about a year ago there were 60, and then there were 120, then 180, and now there's more than 200. Generally, I'm a big proponent of any company holding Bitcoin as digital capital on its balance sheet. I think that's good for the company, and that's good for Bitcoin. That's good for the crypto economy. Our business has evolved from a company that simply owns Bitcoin to a company that issues digital credit against the underlying Bitcoin. So today, we're the largest issuer of digital credit in the world. If thousands or tens of thousands of other companies buy Bitcoin, that will be good for Bitcoin and good for our business. So it's helpful. Out of those 250 crypto asset companies or crypto treasury companies, only a couple are in the business of issuing digital credit. Examples would be Strive, that issued a treasury credit instrument about a month ago, and then Metaplanet, the biggest Bitcoin holder in Japan, that actually just issued their first digital credit instrument. So there's 3 of us that are in the digital credit market. There's probably 200 to 300 that are holders of crypto assets. It's all good for the crypto economy. They'll all benefit. But the exciting thing in the market right now is digital credit. Before November of last year, before the red sweep, there was a lot of uncertainty over the asset class. And so I think a lot of publicly traded companies were afraid to go into space. We have a very supportive administration. The president has designated Bitcoin as digital gold. The Secretary of the Treasury has said we want to be the crypto capital of the world. Donald Trump said we want to be a Bitcoin superpower. So we're the first year of institutional adoption. And in 2025, you got the support of the SEC, the support of the CFTC, the support of the Secretary of the Treasury, the support of the President of the United States. And so normally public companies are very risk adverse. And with all of those supportive moves by the administration, combined with the accounting profession rolling out fair value accounting, which was a very big deal. Fair value accounting means that when you generate gains, you're allowed to mark them up on your balance sheet. And before that point, you could only take losses. You could never take gains. So the accounting was reformed, and the regulators began supporting the asset in the year 2025. And I think that once those 2 things happened, it became pretty clear that it gave a structural competitive advantage to a public company to have Bitcoin on their balance sheet, because Bitcoin has been growing 50% a year for the past 5 years. And so all things considered, if you're buying Bitcoin, you're buying the world's dominant digital monetary network growing 50% a year. And the alternative would be to hold something growing 5% a year. I think that generally public companies will start to buy more digital assets and hold more digital assets on their balance sheet. And I think that Bitcoin adoption is going to spread, and that will be good for Bitcoin, and that will be good for those companies. I think the real story going forward is going to be digital credit. If you think about the perfect product is a bank account that pays you 10% when the money market's offering you 4%. And so if you can offer people 600 to 800 basis points of additional yield over the risk-free rate, whether it's in the euro, the yen, or the dollar, then everybody's reaction is, yeah, I want that. What's the catch? And so I think that the real interesting idea is that digital capital, which is what Bitcoin is powering digital credit, and digital credit is 2 to 4 times more compelling than traditional credit instruments for people that want fixed income.
Bitcoin's trajectory is being primarily influenced by institutional flows, which have become the dominating factor. During the month of November, large exchange-traded funds, ETFs, redeemed billions of dollars, which exacerbated the loss and sparked fears of more declines. IBIT, which is owned by BlackRock, alone had net withdrawals of more than $114 million in a single day, which exemplifies how rapidly expectations have moved. It would indicate that even long-term institutional holders are decreasing their exposure, as they would rather wait for clarity than take on additional volatility. On the other hand, the landscape is not entirely bearish. While many funds had significant withdrawals, others, such as Fidelity, ARK Invest, and Grayscale, reported new inflows, bringing the total amount of money contributed to U.S. spot Bitcoin exchange-traded funds to $71 million by the end of the week. This split provides evidence that conviction has not vanished, despite the broad caution that has been expressed. Rather, it is simply becoming more selective. While some institutions are taking a step back, others are quietly treating the chaos as if it were a window of opportunity for long-term accumulation.
I think this current administration has decided they want to embrace digital assets, digital finance, digital capital, digital innovation, digital intelligence. And so you have a very progressive administration, a progressive set of regulators. And the combination of that progressive leadership with constructive legislation like the Genius Act, which legitimized stable coins, opened the way for all these crypto exchanges to come public and for the successful Circle offering. I think that what you want is a set of regulators that want to see thousands of companies launched and see hundreds of billions of trillions of dollars of value created. And you've either got that or you've got a very regressive regime, which is more concerned about something going wrong, and they tend to damp out all that innovation or block those IPOs. There are two hemispheres to the digital assets industry. One side of the assets industry is based on Bitcoin. It's digital capital, and the killer application is digital credit, a bank account that pays you 10%. Okay, my company's strategy is on that side of the business. We're just offering credit instruments. If what you want is to hold digital capital, digital gold, and you want to hold it forever, or if what you want is to invest in digital credit, and you want that kind of amplified exposure, you would buy our equity. The other half of the digital assets economy is digital finance. And the killer application of digital finance is tokenized currencies like stablecoin or tokenized securities or tokenized memes or tokenized brands or capital raising, et cetera. And that tends to have exploded over the past 12 months because a very supportive crypto administration has encouraged all of those things to grow. So if what you want to do is invest in digital finance, you would have to decide which of those networks you think is going to be the winner, and you would do that's a tech investment. But if you're more of a credit investor or a capital investor, then you would want to invest in digital capital or a company like mine. I think she's alluding to her enthusiasm for digital finance, which is about tokenizing currencies, but I think that they're separate opportunities. People that are excited about stable coins are focused upon payments technology. How do I move money at the speed of light, or how do I improve the Visa network or the MasterCard network or the traditional banking system using digital technology? The value proposition of Bitcoin is digital capital. It's someone that wants to store their value for the next 30 years. So if you think about it, you don't know of any billionaires that are going to sell everything they own to buy US dollars and put it in a safe. So you don't really have currency. Currency is the dollar competing with capital. Stable coins are digital currency. It's a different industry. Bitcoin is digital capital. Bitcoin is competing with gold. It's competing with real estate. It's competing with public equity, your Mag 7 stocks or your S&P index, or private equity. And people that have always owned those capital assets in the 20th century, and they're thinking they want to own digital capital. Stable coins, on the other hand, they're competing with traditional credit card networks or traditional banking networks, and they're offering people with digital payments technology all around the world. Ultimately, the big winner in the stablecoin movement is going to be the US dollar, because what it means is that every foreigner will be able to use dollars instead of using pesos, bolivars, rubles, CNY, euros, any African currency, the rand, etc. So the dollar is the winner, the US is the winner, and then the technologists that enable and host those digital dollars, are going to be successful companies. There's thousands of ETFs and there's tens of thousands of public securities. As I was saying, the distinction here is there's a digital finance economy built around proof of stake networks and all of these altcoins. It's a very competitive business, but it's very exciting. A lot of people are interested in it. It's the networks and the exchanges you'll use to tokenize currencies, to tokenize brands, to launch meme coins, to tokenize securities. That's an evolving business. It's competitive. If you're invested in it, you need to be a sophisticated tech investor to understand it. And the future of that business will be largely determined and channeled by the resolution of the Clarity Act, which is the next big piece of crypto legislation that we expect to come in the first half of 2026 at this point. So it's happening. It's complicated. Well, I think everybody in the industry is looking for clarity. They're looking for some clear path forward. How do I tokenize my security? How do I tokenize a currency? How do I raise capital with crypto tokens? What kind of decentralized or digital finance can I engage in? What are the rules of the road? And I think that's what we're expecting to have resolved in the Clarity Act. Our business model is to issue the credit. So we're selling public credit like STRC and STRD, STRF, and we've sold about $8 billion of that public credit. So we will issue billions, then tens of billions of dollars of public credit, and our Bitcoin is the collateral backing that credit. So that's our business. I think the formation of bank credit networks around Bitcoin is very auspicious. It's very good for the asset class. If banks would not give you a loan on real estate, your real estate values would be lower. And if banks were unwilling to give a loan on a stock portfolio, then that would impair a lot of people that want to invest in stocks. The banks are moving into offering credit on digital assets and especially on Bitcoin. That will be good for the banks. That will be good for Bitcoin. And it's merely an acknowledgement that there's $2 trillion of wealth that is unbanked right now. And this is the banks beginning to move into this new asset class and provide banking services to the $2 trillion of holders. I think it will continue progressively. I think that there are very positive moves. There's good positive guidance from the banking regulators right now, directing banks to begin to support Bitcoin. There are really good moves from the banks. They've all announced they're going to begin to custody and hold Bitcoin. That helps. I think there's some positive guidance coming from Basel and the Basel working group that they will start to upgrade the collateral value of Bitcoin for bank balance sheets. That will be very helpful. So I think that all of those things will generally accelerate institutional adoption. Every single month that goes by, there are more large institutions that come out in favor of digital assets and Bitcoin in particular. And every single time one of them announces that catalyzes another to consider doing the same.
Around the $80,000 mark is where Bitcoin's most important support has been located. The price might be dragged towards $70,000 if there is a definitive break. And in the event of a more severe decline, it could even be dragged into the mid-$60,000 region, even if there is no assurance that there will be an immediate recovery. There are some subtle indicators that purchasers are gradually recovering confidence as December unfolds. The panic that many people anticipated simply has not happened. Passive selling is becoming less prevalent, and inflows are returning to certain exchange-traded funds. In the event that Saylor is correct in his assertion that the 4-year cycle has come to an end, the future of Bitcoin will be influenced less by the predictable timescales for halving and more by global capital flows, institutional behavior, and macro liquidity. This shift may be unsettling at the moment, but it also represents the beginning of Bitcoin's metamorphosis into a truly macro asset. This is the point at which volatility transforms into opportunity. Shakeouts lay the groundwork for the subsequent large surge.